Bond yields rose yesterday after Fed Chair Jay Powell did little to ease investor fears. And that makes today's jobs report a potential market mover. Right now, you're looking at the 10-year yield at 1.545%. Joining us right now is Michelle Girard, co-head of global economics at NatWest's Markets. Also, Matt Hornbach, who is global head of macro strategy at Morgan Stanley. And welcome to both of you. Michelle, why don't we start with what Jay Powell had to say yesterday? Probably not all that surprising, but when you think about it and you watch what happened with the yield in the 10-year, did that make sense to you?
You know, Becky, it wasn't what he said. It was what he didn't say. The markets are looking for some reaction from the Fed chair to the rise in yields that we've seen over the last couple of weeks. And so what they were hoping to hear was that he was taking notice of the rise. And he did say that. But there was no concern about the rise to the level that there's any indication the Fed might be thinking about taking actions to sort of stop the 10-year yield from rising. And by that, it would be that in any way he would signal that the Fed was considering doing more in terms of shifting its purchases to buying more of that longer term debt. And so there was disappointment that while, the Fed chair acknowledged they're watching, nothing at this point had got them concerned enough that they were kind of rethinking whether or not they needed to take action.
It's kind of a stupid temper tantrum, isn't it? I mean, we hope things are getting better. We think we're going to get back to a more normal economy. We think things are opening up and we're starting to win on the COVID front. Isn't that all great news? And by the way, shouldn't rates be higher?
Well, and here's the other thing. What's pushing yields higher is not really higher inflation expectations, because actually inflation expectations is not what's been driving this move up. It is, just as you said, Becky, an expectation, a growing expectation that the economic outlook here is improving. And that is something that the Fed should welcome and not be pushing back against.
So, Matt, let's talk about it from the equity side of things. Obviously, if bonds look more attractive, stocks may look a little less attractive, relatively speaking. But do you think that this is a serious pullback that we're going to be starting to see, the beginning of something? Or do you think that this is just a traditional move as you start thinking about a reopening economy versus one where we've been in lockdown?
Thanks for having me on, Becky. I do think that higher real yields in particular are something that the equity market does need to pay attention to. And as Michelle said, this most recent move higher in bond yields has been more led by real interest rates moving higher than break-even inflation rates moving higher. At the same time, the bond yields have been moving higher for the past 6 months. And of course, most of that larger move has occurred with break-even inflation rates moving up. So that's one of the reasons why the equity market was able to take it so well, right, since August when bond yields actually bottomed. So I think that if we continue to see higher real yields in the absence of the type of data the Fed would like to see, particularly on the labor market, yeah, the equity market may have a tough time moving higher from here.
One thing we have seen is a much bigger pullback, Matt, on the tech stocks. The Nasdaq's been down significantly more every day versus the S&P, but especially versus the Dow. You kind of see more strength in the industrial names, more strength in the manufacturing names, and a pullback from some of those tech high flyers that have just done so well over the last year. Again, you think this is the beginning of something, or do you think that this is kind of reshuffling that makes sense, and then we kind of move on back to a less significant swing?
Yeah, I think that the latter is more our view, Becky, is that, we're still in a secular bull market for the equity market here. The cycle began pretty clearly back in March of 2020. We think it's got further to run, big picture. But yeah, more recently, a bit of reshuffling is in order given the stress positioning that showed up in the equity market. And look, at the end of the day, the pricing of the bond market's important here. Right now, the bond market has the Fed hiking rates 3 times by the end of 2023. And in fact, one of the first of those hikes is expected to come at some point in latter 2022. Unless we get the data to support that type of bond market pricing, things are gonna struggle near term, but the medium term, everything will be fine, we think.
Michelle, what do you anticipate that we're going to hear today when we get that jobs report at 8:30 Eastern time? The ADP report was weaker than had been expected a couple days ago.
Well, we also have a kind of a weak forecast. We're actually looking for a decline in payrolls, and unfortunately it's weather related. Unfortunately, meaning that I think there's going to potentially be some noise in these numbers because we did have a number of snowstorms that hit various parts of the country right during that survey week, and so it could be that we get a number that's weaker than what the underlying trend is. Although let's face it, the last 3 months the trend in payroll growth has been softer as the economy was forced into, renewed lockdowns around the turn of the year. So we've seen a bit of a loss of momentum. I think people are willing to look by that because we are now getting hopeful about vaccine distribution and a pickup as we move into the summer. So I do think we're still at a point where these data may not be telling us what we really need to know about, the prospects for the economy to kind of improve. It's a little bit backward looking. And again, this month in particular, maybe, a function of the weak numbers could be a function of some weather distortions.
Shepard Smith here. Thanks for watching CNBC on YouTube.